If you buy $2,000 worth of a company's stock and that company burns to zero, your loss is exactly $2,000. Your risk is capped at the cash you put in. But there is another market called futures and options, or F&O, that pulls in millions of traders by promising the same stakes for only a fraction of the capital. This leads to a mathematical paradox. A trader puts down just $200, the market dips, and they suddenly find themselves $300 in debt to the exchange. This infinite hole of debt represents the literal mathematical certainty of the F&O system. To understand how a $200 bet can actually bankrupt a person, we have to look into the hidden mechanics of the stock exchange. The low entry price of F&O is an illusion that hides a trapdoor of massive risk that most retail investors never see coming. Take a plain wooden cricket bat. On its own, it has a simple, intrinsic value based on the wood and the craftsmanship. But once Virat Kohli signs that bat, its market value detaches from the wood. Its price now fluctuates based on his real-world performance. That is a derivative. In the market, F&O contracts are the signatures. Their value is derived entirely from the price of an underlying company's stock. The first version of this is a future. Imagine booking a student apartment months in advance to lock in a cheap rent price before the semester starts. If the market value of that room plummets during a lockdown, your contract still forces you to pay the high price you locked in months ago. A future isn't ownership of a stock. It's a strict, inescapable financial obligation tied to a future date. This makes options look like a safer bet. You pay a small, non-refundable premium for the right to buy the stock later, rather than the obligation. If the market crashes, you simply walk away and lose only that small premium fee. On the surface, it feels nearly risk-free. But the trap is hidden in the volume. Exchanges don't allow you to buy an option for just one share. They mandate lot sizes. You are forced to buy contracts covering massive bundles of stock, often hundreds of shares at a time. This creates leverage. That tiny premium fee is now legally controlling thousands of dollars worth of underlying stock. This leverage is essentially a massive invisible loan the exchange provides to let you trade at this scale. Options function as massive financial commitments masked by a small entry fee. Applying this to our opening mystery, a trader uses a $200 premium to control a lot size worth $20,000. If the stock price moves up just slightly, the leverage multiplies those gains, handing the trader a 100% profit on that original $200. But then comes the black swan, a catastrophic market drop that breaks every normal expectation. This chart of the March 2020 crash shows how a black swan event can wipe out a leveraged position in a single afternoon. The crash doesn't just take your $200 premium. Because you control the whole lot, you are responsible for the massive drop across that $20,000 bundle. You are legally required to pay that difference out of pocket to cover the invisible loan. Ultimately, F&O operates as a volatile contract system where leverage turns small bets into life-ruining debt.